Okay, S&P Global's economists say the global recession is here and now. We've certainly seen the concerns intensifying over the last several weeks as we've seen businesses shut down globally because of the pandemic fears. Joining us to discuss is Global Chief Economist for S&P Global Ratings, Paul Gruenwald. Paul, it's great to have you on today. Walk me through your thesis here in terms of assessing the recession that you say is already here, because it paints a pretty grim picture.
Yeah, well, first, thanks for having me on the show. A number of things led us to this conclusion to make the call for a global recession. First was the accelerating spread of the virus in the U.S. and Europe. Two was the sharp restrictions of people-to-people contact and what that does to activity. And finally, we're starting to get some early data on the effects of the economic effects of the virus in China, and we saw industrial production drop by 12% year-on-year in January, February. So it was becoming increasingly clear to us that we're in for a very sharp decline in activity from now until probably the middle of the year. So we're entering a global recession, so we made the call.
So let me pick up on that point about the data we got from China, because I think when those industrial production numbers came out, as well as the unemployment numbers, there was certainly a bit of a gasp. We were expecting a big shock. This was much more than was expected. What are the parallels that we can draw between what we're seeing in China weeks after they have seen the peak of this pandemic and what is likely to play out here in the U.S.?
Well, first of all, you're right. The market was looking for something like a 3% decline in industrial production in China. It was 4 times that large. But we don't really have any models in economics for mapping a health event like this into economic variables. What these restrictions on people-to-people contact are doing is putting a big dent in demand. We know here, for example, in the U.S., sporting events have been canceled, entertainment's been canceled, the kids are home from school, the parents are home from work, so a lot of the discretionary spending is getting hit. We actually think that's going to be the main channel, and how severe it is and how long it lasts is really kind of an open question right now.
Paul, we opened the show talking about the ballooning of corporate debt here as we move along in all this. And when we think about how much that really has ballooned, since 2008, corporations worldwide have issued about $1.8 trillion in new bonds each year. That's roughly double the pace that we saw over the last 7 years. And a new survey from Bank of America says that a record net 53% of fund managers surveyed said corporate balance sheets are over-leveraged. So when you digest all of that, at least sitting here, it seems surprising that we haven't seen more downgrades when we think about the credit ratings for some of these companies out there. Number one, why is that? And number two, where do you think that might happen first when we think about companies that are maybe too over-leveraged here as things slow down?
Yeah, well, first of all, I'm an economist, so I'm not a rating analyst, but my credit colleagues did put out a parallel piece this morning with myself and my team. They're looking at sectors that are going to be most hit by the sorts of things we're talking about: travel, entertainment, oil and gas for the big drop in energy prices, et cetera. So I can't comment on the rating specifically, but we know that the impacts of these, the coronavirus, the economic impacts of the virus are going to be uneven. So they're very focused on those most vulnerable sectors right now.
Paul, let's walk through some of the numbers that you have put out now, because you're calling for, or you're looking at GDP growth of 1 to 1.5% globally, a contraction over in Europe of 0.5% to 1% this year. When you look to the government response that's happening, not just here in the U.S., but in Europe as well, is there anything that, I guess I should rephrase this by saying, what would it take for you to maybe change your outlook on that front? In other words, is there a stimulus package that we could see passed here in the U.S. or over in Europe that could be significant enough to maybe reduce the shock that we're seeing in the system right now?
Right. Well, first of all, I think it's kind of obvious in the current environment it's hard to make point forecasts. That's why we went to this model of using 0.5 percentage point ranges. We've got implicitly baked into these forecasts some sort of government response, but I think it's going to be the fiscal response is going to have to be something that addresses the most affected parts of the economy, whether those are the sectors in trouble or the SMEs. We've seen some countries like New Zealand roll out subsidies to keep people on the payroll. So all of this is going to be a form of damage control. It's not necessarily going to be cheap, but we think those sorts of measures are going to keep demand strong. The labor market's going to be key to watch for the next couple of months. In terms of getting the forecast numbers higher, we still think the risks to our forecasts are on the downside. It's really more about the health effects, to be honest. As I said, there's just a huge amount of uncertainty right now. And until we see some stabilization in the health numbers, and all the health experts say that's going to be a while, I think we're probably going to stick with a relatively pessimistic forecast.
Okay, Paul Gruenwald, appreciate you helping us make sense of all of this, the global chief economist for S&P Global.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.